In this episode of Future Intersections presented by Wells Fargo, we're going to discuss financial technology and what's driving change. The last few years have been a roller coaster for fintechs and venture capitalists. How has the market evolved? What can we expect in the future? Join me, Ather Williams III, and my special guest, Matt Harris, partner at Bain Capital Ventures. Prior to working at Bain Capital, Matt founded and ran Village Ventures for 12 years, focusing on early-stage fintech investing. Over the course of his career, Matt has seen huge amounts of revenue, profit, and market cap shifting from regulated financial institutions to entrepreneur-led insurgents across payments, capital markets, real estate, and insurance. He has a wealth of experience to share. Let's dive in. Hey, Matt, welcome. Great to see you.
Yeah, I'm excited to be here.
Yeah, so it's been a while. So we've had this ongoing dialogue for a bunch of years, going back to prior institutions. Obviously, you've been the one constant at Bain Capital. But when you came to talk to our senior leadership meeting last year here at Wells, it was kind of a different environment around sort of fintech, big tech, and what was going on in the payment space in particular. Then we flash forward kind of a year or so, and things are different. So what do you see in the marketplace around venture investing, fintech, et cetera, that's sort of changed from last year?
Well, first of all, I loved coming to that meeting with you and the senior leadership team, and it was a remarkable point in time because generative AI had just sort of reached consciousness, and it was one of the early larger meetings I was in where there was a real live demo of generative AI. You'll recall. It clearly had captured people's imagination, even though this was the very early days in Q1 of this year, of 2023. And yet, we were still very much in the doldrums, particularly for fintech companies coming off of 2022, which was a miserable year of readjustment to new multiples and higher interest rates and new scrutiny, let's say, on business models, et cetera. So it was a great pivot point where on one hand you could see the birth of the new, and on the other hand we were very much still in the throes of a reset downward. And then now if you go to where we are today, I think you see the reset is over.
Yep.
I think in the private markets there's still not a lot of deals happening, but you can see more. Sellers are getting more realistic and buyers are getting a little more excited, not least because generative AI has turned out to be more interesting than just a novelty toy. It sort of appeared in the beginning of this year.
So maybe you get to take a step back. And so when you think about your universe for investing and where you have the confluence of technology, I'll call it payments, and now generative AI and all forms of AI, even though part of the generative deep learning stuff is more newer, more impactful, could be more revolutionary, disruptive than anything else has been. How do you think about your investment thesis and sort of how you're thinking about this playing out?
Yeah, so at Bain Capital, our culture is one where we focus first on the business problem at hand. And I contrast that to a lot of firms who focus on the tech itself, perhaps. And then secondarily think about what problem could this solve. So we're organized very much by industry, meaning I get the luxury of thinking about financial services all day, every day. Mm-hmm. I help my colleagues think about private equity and credit and other asset classes, but mainly my day job within financial services is the venture capital asset class. So working with founders who are maybe just have an idea or maybe $10 or $20 million of revenue, kind of in that band is where I play. And I'm attracted to founders who are extremely adept with technology, who are native technologists, product and engineering folks, but who have in their mind very clearly a business problem that they can use technology to solve. And that keeps us out of a fair amount of trouble. We don't end up in these deals that have whiz-bang tech, but nobody who seems to care.
Yeah, which I think has been a historical problem. There's lots of cool technology.
Yeah.
I mean, we've had this ongoing conversation about I'll call it various forms of tokenized currency,
right,
which, at some point we'll probably get to a place where it has a lot of value, whether it's in a central bank digital currency form, stable coins for markets that are less have higher hyperinflation, or et cetera. but it seems like a little early. It was a technology that the business problem wasn't quite here yet. When you think about AI now, what are the problems that now enables us to tackle in financial services that we hadn't been able to address before?
Well, they're mainly back office type problems. Our kind of internal framework is a 3-phase impact across most industries, but particularly financial services, where it is changing how people run the business in these departmental levels. Customer service is kind of the most obvious. Right now, generative AI is pretty good at reading and writing. And so if you look at tasks that involve, you can imagine sort of somebody swiveling between screens. They've got to understand content on one screen. They've got to output some content, maybe to a customer, in the case of customer service, on the other screen. That job is at risk because that task of comprehension and then summarization or communication actually is pretty good. Generative AI is pretty good at that. And so I think that's where we're seeing customer service, some sales and marketing aspects, and then engineering, programming particularly, helping programmers get more productive. And what we're seeing is that skilled programmers can actually become even more productive, whereas new programmers, it's actually less impactful at right now where the tools are. So we're taking these horizontal functions that help you run your business. They impact most businesses. Mm-hmm. And there are 20-30% productivity gains to be found. I think what comes next is changing how you do the business, how you do commercial loan underwriting, how you do wholesale payments, those actual business functions, not just about reducing OpEx, mm-hmm. but actually changing how you deliver your current value propositions. I don't think we're there yet either. We're not seeing real changes, particularly in financial services, not least because of regulatory concerns, mm-hmm. privacy concerns, and then, of course, the concerns about black box and controllability and visibility into these models. But that's the inevitable next phase.
Yeah, so I think it's a great framework. One we probably should apply more rigorously here at Wells, because I think that as we're starting looking at use cases for all forms of artificial intelligence, obviously the machine learning stuff's been in process for a while in fraud detection and other places, card authentication, et cetera. But the contact center environment and that sort of combination of allowing people to do self-service in real time, allowing the phone person, the operator or banker, when they're actually talking to an individual, to do what individuals do best, like be empathetic, right. Deep listening stuff, while you could have an artificial intelligence who's doing, they're listening, they have a complaint, let's log that and send it off, or they're asking about this, and we pre-populate the information you need to know, so you're not searching the screen, half listening, half trying to do stuff. That stuff, I completely agree with you.
And just to follow up on that, Ather, because I think you introduce a few really important ideas there. One is we've been doing AI for a long time. And I think it's worth remembering that, like predictive AI, analytical AI, this is not new, and Wells is very good at that. I remember you set up a center of excellence. You probably have had multiple, but it was 4 or 5 years ago. You really leaned in. So this is not a new endeavor at Wells and other places. And then the second is this keeping humans in the loop thing. One of the key points is robotic process automation on the back of these systems. So as an example you mentioned that is similar to one that I cite frequently, which is that it's quite possible that the communication actually still has a human, particularly in financial services and healthcare where empathy is so vital. And yet the necessity for that human to then have a bunch of to-dos on the back end is probably not going to happen anymore.
Yeah.
Somebody listening and saying, like, I hear account opening, I hear interest waiver, and then kicking off processes through robotic process automation, I mean, it's magic. And it will reduce the labor costs, and those people can be deployed to do other things. But it also is going to make people's jobs actually a lot more interesting.
I think the hurdle that I find that we work through with all of our leaders is you could fundamentally reinvent what the job is, whether it's a contact center person or candidly, like I think about a first-year analyst in the investment bank.
Right.
Like that job is pull numbers, spread numbers, do research, all of which could be done in the click of a button, and it's a couple simple prompts.
Yeah.
You can pull that all together if the data is, if you know where the data is.
Right.
And then the job changes to be much more higher functioning, to your point, where you think about what does this tell me, and how is the customer going to react to it, and how do I shape it, versus just pulling together the facts, which I think is something that, I know, as we think about the future of work, and the future of work in banking, what it means to be a banker, we have to think through more carefully. Because I even think about it in some of the businesses I run. We have lots of people who are assembling things or following up on things that are part of a process that don't need to be.
Right, and Wells Fargo is one of the most important American corporations. I mean, you're part of a small group of companies that have an obligation to think about the implications of these things, like kind of society-wide, and I'm glad that you are. I personally worry about the fact this all comes on the heels of COVID, because we had this moment where we sort of severed the employee from the physical proximity with the employer and with each other. We sort of made them digital of necessity, and so many of these members of our team and other teams have chosen to stay remote or default remote, or as much as they can remote.
Yeah.
And boy, I think that's a mistake. In a world, forgetting about the benefits to the employer, but in a world where your job is at risk of becoming digital, and you've removed yourself from the human aspects of it, from the mentorship, from making yourself indispensable in other ways, it feels like that's a 1-2 punch that, again, if I was at a different point in my career, I'm pretty sure I'd be going to the office. No matter what job I had, just, hey, I'm human. I'm here doing stuff that human beings can do. So I do worry about that.
Yeah, and I think that, having three kids, 2 of which are in college, thinking about what their careers are going to be, I can't imagine them coming out of college and saying, okay, now I'm going to be sitting in my living room or my studio apartment in New York, remote working for some company, on the other side of the world, and have no connection to the mission, the culture, or anything else. I don't know. That does concern me.
Yeah. First of all, it'd probably be your living room that they'd be sitting in. But I agree. I mean, I think we've talked a lot about the benefits to the employer of getting the workforce back, and those are real. But I think the conversation needs to shift to the benefits to the employee and the dangers to the employee of becoming a nameless, faceless entity vis-a-vis your work and vis-a-vis your employer. We're entering an age of new peril for white-collar workers, including investment banking analysts.
Yeah.
And those perils include not getting the mentorship, so that when you have to be client ready, you aren't, or simply just not being necessary. So I'm telling my kids, even if you don't have to be there, you should be there.
So artificial intelligence, the impact on the workplace is one vector of change that we're just sort of tracking. As you mentioned, you spend a lot of your time with, founders, people who are steeped deeply in technology, solving business problems. The other side of that spectrum now, when we've had this conversation historically, we've been talking about those people, disruptors from small, who are going to grow into large. And there's been many of those that have happened, and particularly in financial services. However, the other side now is we have big tech companies.
Yeah.
Right. So the monsters, whether, they're big platform players, big people who have their own ecosystems and hardware, who are all sort of through various regulatory regimes and are all around the world moving into financial services pretty aggressively. We've seen some models that have been revolutionary, like in Asia, and some of those things are starting to come into the U.S. How do you think about that in terms of what it means for innovation in the future of financial services here in the United States?
First of all, it's fascinating that you refer to them as monsters, because it's one thing to worry about these little ankle biter companies. It's yet another thing to think about these enormous companies with massive capabilities as competitors. That's a whole different order of magnitude. I think one of the governors on the majority of the companies we could name, like Google, Facebook in particular, is that they serve the financial services industry.
Yeah.
I mean, it's mission critical. I think about how many times Google has tiptoed up to the line of competition, and then, including recently here with Citibank and Plex, they just can't do it. I mean, they just look around the business and say it's not worth it. Maybe someday they'll get past that. And the same will be true for Facebook, inevitably. They just earn a huge amount of money from financial services. And Amazon, who 10 years ago I would have said could be gloves off, and if you look at what they were trying to do in payments 10 years ago, it was much more aggressive, I would say, than their current posture. And AWS plays a big role in that.
Yeah.
It's hard to visit Charlie and pitch him on going to the cloud one day and then, try to steal his payments business the next day. That's just a little harder. So honestly, for me, it reduces down to Apple as the player with the least to lose and the best hand. And those two taken together, I think, are worth paying attention to.
Yeah, and I would agree with you there. And I think that the two other things I think about there, one, and I'd love your perspective on this, over the last 5 to 7 years, the regulatory framework hasn't really changed, but the interpretation for what's allowable has. And so tech companies can do banking activities working with a bank that candidly probably is definitely not as regulated or as controlled or inspected as we are.
Right.
And then you have other banks that have, companies like Apple who've done partnerships that we all know are very public around credit cards or saving or checking accounts, et cetera, that aren't panning out the way at least one partner thought they would.
So it appears.
So it'll be interesting to see how that model evolves. Is sort of in 2.0, what happens. So I don't know if you have a perspective on sort of that small bank empowering fintech, which was the early thing with Chime and other things. It was like that was the model, but now you have gigantic companies doing the same thing, which is a very different implication. I don't know if you have a thought on that.
I think about it all the time. And I would not have predicted that the Durbin Amendment, which is so important to everything that happened later in terms of fintech, would have kind of stood the test of time. But by creating this at least two-tiered system with smaller banks who can do more or less whatever they want and earn outsized economics, and larger banks who, if you take Dodd-Frank as a whole, were dramatic losers in that moment. It was just a shift of economic rent from large to small, and freedom to operate from large to small. Fascinating moment that I thought in the cooler heads in calmer times would get revisited and does not appear to have. This is sort of what we're dealing with. And even in 2023, new rules come out around nesting and layering and how fintech architectures can work. And it turns out those rules only apply to the big banks. I think scale companies like Apple will have a very hard time interfacing with Durbin-protected banks. And so they will face a pretty stark choice, which is become regulated or figure out a way to have a set of partners that are of an equal scale to them. And so I think this is ultimately good news for whoever comes after Goldman Sachs as the key partner to Apple, because there will be one or more likely several counterparties who will retain a share of the profits of whatever Apple does.
The Federal Reserve has actually doubled down sort of in payments, right? So they've done these two things of note that my team and I spend a lot of time on. So the first is they've been experimenting with digital currency, right? And so we participated in the regulated liability network, the first pilot. We're looking at phase 2 and sort of understanding what that could mean for clearing settlement funds, and then more importantly for us as an institution, what solutions we could build on the back of that, given new speed and new transparency and new information flow. The second thing is they launched a real-time payments rail, which, we had real-time payments in the clearinghouse, launched 5 or 6 years ago. Now we have another rail, which between the two should get to some level of ubiquity across the United States at some point. It'll take a ramp time, but that's the hope. So I'd love to get your perspective on those two things. One is on sort of digital currencies and where do you see the future? Because I think it's the first use case is never the one that ends up being, but now we've seen some maturity. You're seeing a lot of things. You probably brilliant people pitching new ideas all the time. And then given now we have real-time payment rails, does that lessen the case for our cryptocurrency?
Well, I think we should acknowledge that it's kind of remarkable that the clearinghouse and the Fed pulled this off. I mean, this is a Herculean, you've been in the guts of these things, very hard things to do.
Yeah.
And that both of them worked on the timetable that was laid out, and now we have two nice things where we never had it before. So I am impressed with both bureaucracies. Of course, one is a consortium and the other is a government, but neither is the ideal form of governance, let's say, for getting stuff done. I do kind of regret that there are two. I hope interoperability is very high on everyone's agenda, because as I think about the Fed's natural bank constituencies. I observe it being smaller banks, and I think about, of course, you can look at the owners of the clearinghouse, and those are larger banks. And so if we ended up with two systems that were actually independent, that would surely not serve the customers. But if we express confidence that that will happen, I personally think that this may be finally the match that lights the sort of kindling of open banking.
Oh.
That if you layer open banking on top of real-time, slightly more data-rich rails, as importantly as the timeliness actually is just the modern field system and the pull mechanisms and request to pay and all the communication layer stuff and liability management, that is all, to me, an upgrade from the ACH system. And so you could imagine those two things developing in parallel to where certain types of merchants, think maybe field type merchants, plumbers, et cetera, are not taking card. And instead, and they're moving away from check and moving towards open banking style retail transactions, which in the United States has been really non-existent. Leveraging account-to-account style rails, it has not happened. And now you've got the ingredients. And so who are those brilliant founders or executives at financial institutions who can come up with those compelling use cases for merchants and for their customers? It won't be e-commerce in the first instance, likely, or even physical point of sale. But there's lots of transaction types that lend themselves to, bank account style payments. But I think what I'm excited about is this the thing that makes open banking mainstream? And what does that mean for cards? What does it mean for crypto? I said at a conference recently, people asked me what I thought was going to be interesting in 2024, and I said the reemergence of crypto. And everybody laughed. Everyone on the panel laughed, and the audience laughed, and then they turned back to me like, well, that was obviously a joke. Well done. What's your real answer? Which is just to say, crypto's been left for dead by the venture community, for sure. It's been something that people, in some cases, were grateful not to have to think about anymore. We've kept thinking about it. We have a dedicated internal team, primarily of researchers, who are working on the ways in which protocols and tokens can start to actually solve business problems.
So so that was going to ask you. So what if you think of the use case that crypto could be the panacea or the solution for? What would that be?
My view that the reemergence of crypto is going to start at sort of the wholesale settlement layer, a world that you're very familiar with. We're seeing just experiments at this point. We're still in proof of concept phase, and obviously everyone's being a lot more cautious than they were first time around, and there's a lot less innovation theater around blockchain and the stuff that you kind of had to do 5 years ago. But I think this pilot with Visa, Nuvei, and WorldPay, whether it in and of itself moves forward, it sort of points the way to where there are real cost savings. And that gets people's attention. I personally am skeptical about CBDCs. I think when the powers that be think about whether they want a new account structure that moves liquidity out of the banks, I think they will decide that's probably a bad idea.
I agree.
I think bank liquidity, maybe last year we were less worried about, but I think in 2023, where everyone agrees that bank liquidity is a good thing.
Yes.
And honestly, I think the degree to which treasuries are sucking liquidity out of banks already is an underreported matter. It's much, much easier to buy treasuries than ever for consumers and for corporates. And why would you keep your money with a bank if you could just put it in treasuries? So I think that ultimately will create an issue for CBDCs, except in countries where they want to surveil the money.
Yeah.
That's a darn good reason to have a CBDC, is to make sure you know where every unit of currency is going. That doesn't strike me as the sort of thing the U.S. government is going to pursue. And so in that absence, we have upgraded money rails, but particularly when you introduce cross-border, they're not perfect. And this instantaneous settlement of a distributed ledger that is programmable, that you can build true software to integrate directly into, in a way that is much harder with payment rails, that to us is compelling. It will start in the fringes. It'll start at the margins. It'll start with proofs of concept. But, we get paid to play the long game, so we're allowed to experiment.
Oddly enough, the problem that I think thinking about our clients, the problem I'm trying to solve is we still have too much paper. It's amazing in the United States in 2023, the number of checks and amount of cash we still have in circulation, and the billions of dollars it costs to process that, and also the fraud associated with it. Like, we're seeing increases in check fraud, like check kiting. Like, you thought that was dead 20 years ago.
Right.
Goes back to that Leonardo DiCaprio movie,
Exactly.
but it's coming back. It's fascinating to think about either what you mentioned, business to business, or the context where we haven't been able to solve for cash and check. Now, some people always prefer cash for its anonymity, to your point about surveilling money. But sometimes we just make it difficult, either because of the cost of payment acceptance, to your point about the plumbers and small workers. So I'm optimistic that we can find the right use cases to power those rails and realize that, there's certain, we're not talking about big box retailers, but the local plumber doesn't have the same economics. So we should think about the payments differently, and it's advantageous for the industry to make that not paper-based.
I'm really glad to hear you say that. I think that Visa and MasterCard and the associated issuers and acquirers have done an incredible job advancing the cause of digital payments. And there's more to go. I think the big buckets, of course, are B2B. And a lot of my investing activity has been introducing software-driven workflows. And B2B, it's less about the rail and more about the workflows. And it's even less about things like rewards and incentives, et cetera, that can change behavior at retail, point of sale, or in e-commerce. In corporate life, you have to change AR departments' habits, and you have to change accounts payable departments' habits. There are incentives, like straight-through processing to save labor costs, and like timeliness benefits. And so we've invested in, two handfuls of companies at both sides of that over the last 10 years and really enjoyed that experience. But one of the things I note is that we have a long way to go.
Yeah.
A long, long way to go.
Yeah, I think from having spent most of my career in big banks, we're in this shift where, from a wholesale payments perspective, everyone was focused on the rails. Like, do you want a wire? Do you want an ACH? Do you want now a real-time payment? That was sort of the conversation. Now, I think is the benefit of what fintech and even big tech have done is, to your point, they focus on the workflow, and they focus on it very specifically in verticals.
Yeah.
And it started in places that are very difficult, like quick service restaurants, and linking that all together. But then it's sort of, I think, on our side, woke us up and say, well, look, we have this broad portfolio at Wells Fargo of 70 million clients across consumers and businesses, and we cover from person just getting their first account to the largest companies in the world. And when you think about what their needs are, particularly when you get into businesses, you start thinking about, well, God, we cover in agriculture. Even agriculture is an industry segment.
Yeah.
The workflows are very different from the farmer to the packager to the trucking company to the grocery store on the other end. And we would have this similar, here's the product set, you figure out how to integrate into your environment. And now we'd be much more thoughtful about how we develop software and experiences or plug into those experiences to power that. And then it's becoming less about the actual, to your point, the payments or the rail, but what information can we provide back to them? And so how we can use more information-rich rails, be it RTP or eventually, a digital currency-based rail that really enables us to provide insight, not only from that customer's working capital flows, but candidly across that network that we have. Because in some cases, we know the consumers that are walking in the one door, and we know all the supply chain on the other end. I think about how we can leverage things like artificial intelligence and now digital technology to align the workflow and now overlay some AI models to really understand what's going on and provide real-time insights to how people can better perform. It's simply about, don't pay this transaction in US dollars, pay it in Thai baht because you're going to get a better rate. Or it's actually like, here are your sources and uses of funds, let's optimize for you. I think there's tons of opportunity.
Right. Or, by the way, upstream in the supply chain, crates are running slow, and so you might want to think about lack of supply of crates downstream, like just your visibility across those segments of the value chain. Of course, your access to the financial aspects, but just your understanding inputs and outputs. It's incredibly valuable. And I think it's really worth noting how much progress is represented in what you just said. I mean, when I started investing in fintech companies, basically the observation was that the incumbent financial institutions were categorized by regulatory type. You know, you had commercial banks and retail banks and broker-dealers and carriers, and then they were organized by product type. And nowhere in any of that was an idea of a customer. And that was true 20 years ago, and it's just less true today. Banks are organized and think about a customer's holistic needs. And yes, there's somebody who runs the DDA business, right? But on top of that, or at least parallel to it, is someone who thinks about a farmer. And those two people are working closely together. That's a modern banking approach that didn't exist 20 years ago. You had a sales channel lined up against segments, but there was no sensibility around product by segment. And I love seeing that. It's better for customers. But the real question, I think, for Wells and other banks is, do we build the software? Now, how far do we go? Are we going to build farming software? Or are we going to partner? And if we partner, how do we extract the right levels of rent? How do we do what we do best and let a software company do what they do best? And that's still an unresolved issue to a certain extent.
It is, and I have the opportunity to solve it for Wells.
Oh,
one of
good.
my responsibilities is running all of our digital assets. And part of that is thinking about, at least the mindset we're taking is that our clients work in a financial ecosystem, of which we may be a large or a small part. And we need to sort of rethink, candidly, it starts with who we have on our platform. So the people who run my digital teams, have, human-centered design, ethnography backgrounds. So they're really thinking about, let's go sit with a corporate treasurer and understand how they do their job, and how do we make that easier? And does it because we can go find a best-in-class software company to partner with and integrate into, because they're further ahead and they've solved that problem? Or is it something, candidly, if we solve, we can do it at scale across 20, 30, 40,000 customers, so we should do it ourselves? And so we're working through that ecosystem, but I think the days of where it all has to be built on our chassis is long gone. And I think we're thinking much more adeptly, not only internally about how we use APIs to connect things together, but candidly how we connect to our partners' worlds and bring value, which is why, for me, the information API or APIs are really important, because that payment rail is going to be, if it's not already rapidly commoditized, is going to increasingly be so in the future. Because a pipe to Wells Fargo, besides counterparty risk, a pipe to Wells Fargo to a pipe to Bank XYZ to send out a payment, not much different. But the insights we can provide, or the liquidity we can provide through our balance sheet or access to capital markets for them, are the combination of things we have to bring together.
Yep, it has to be both. And this is where we've had this theory that as soon as everything is digital, all these interfaces are digital, the customers will actually care a lot less about the rails. They won't even know whether at the back end it's Ethereum that's settling the transaction or ACH or RTP. And we're not there yet. I mean, customers do care and know and have visibility and opinions about the rails now. But I see a world in which the way that cryptocurrency, which maybe needs a different name, gets sort of back in the conversation, is on this wholesale basis where it's just a drop-dead obvious cost savings and time savings. And it's not about the sizzle of it, actually. It's kind of the opposite.
Definitely. So, Matt, one last question for you. So, if we have this conversation a year from now, what do you hope we're talking about?
I'd love to talk more about retail banking.
Okay.
Because I think the current state of play is way too binary between the branch-based folks who have a digital interface that they offer and the purely branchless folks who have a card and an app. And maybe a year's too soon. And there's no investment opportunity for me in this. But I think for the benefit of the consumer, tighter coupling of those things, where companies like Wells Fargo, who have this, let's call it, what I see it, is an advantage of this physical footprint where they can solve problems that are not solvable digitally, and they can do education, and they can do engagement, and they can do very sophisticated consumer problem solving with humans and AI, but in a physical location that's not easily done at home on a device without context and without the availability of humans. I think this next phase of retail banking will be a synthesis of sort of chapter 1 branch, chapter 2 branchless. Chapter 3 is what I'm really interested in, because Americans are not delighted with their retail banking experience. They're not perfectly well served yet. And they need to be. I mean, this is a huge part of human satisfaction or dissatisfaction, frankly, of happiness, is about how safe you feel about your money, how knowledgeable. And that can't be solved from an expense perspective by branches alone. And it can't be solved, I don't think, unless humans evolve rapidly, by digital alone. So that's what I want to spend more time talking about.
Okay. Well, in a year, we'll have that conversation.
Perfect. I look forward to it.
Matt, thank you very much for joining me today.
Great to be here.
That's it for this episode of Future Intersections. I'm Ather Williams III. Thank you for joining us today. Stay tuned for upcoming episodes where we will share advice and insights needed to stay one step ahead in today's ever-changing business landscape. If you really like this episode, please share with your peers and network. If you have a topic you'd like us to address or a guest you'd like to recommend, email us at futureintersections@wellsfargo.com. Future Intersections is produced by Wells Fargo.